Welcome to Modcast number 15. I'm Gordo, and that's Gary. The man is back. He's been MIA for the last 3 episodes, for those that have been keeping track. We had Tuck come on and talk about investments and building an awesome platform. We had Mike come on and talk about platform. And then we had Mike back, and he talked a little bit about, value drivers in an RIA. But the man is back, Gary Roth. How you been, man?
I've been good. Yeah, listen, I had to get back here to keep my seat. I didn't want to get
it was getting cold,
canned from my own show.
Well, you're a co-host, but where the hell were you?
Well, I had we're very open and transparent on this show, so I'm happy to share. I had to have a little bit of surgery on my neck, my cervical spine.
Okay, wait a minute. You just said 2 things that are in complete conflict.
They're not in conflict.
A little bit of surgery, and neck surgery. Like those.
Yeah.
That's.
Well, I'm minimizing it. I'm being tough.
Got
it was something I had to have done. Maybe we do like a medical modcast one day. I don't want to gross people out about the details, but it's just kind of a thing I had to have fixed, and I had to have surgery, and then I had to have a second surgery, and so I'm still in that recovery phase, and our demographic is probably people of the age where these things are not that uncommon, and joint replacements and
like you said, we could do a whole episode on it. I've got a new knee. You've got some new parts. Right. You've got some new neck. It's we
I was joking with someone last week that I think my average age is I'm going down because I've got these new parts.
Right.
So if I can I just needed to figure out what percentage of my body is new parts, and then my real age is going to be if it's 4% new parts, then
Are you 4%?
I can be I can be 4% younger,
or a lot more than 4% younger actually, because they're brand new parts.
Yeah, well, right? it's like this is average age 55, and then this is average age 2 weeks, and so maybe I'm 49 again. I don't know. Maybe I can have a 50th birthday party.
It was a pretty good year for us when we were 49. Anyway,
it was a pretty good year.
Yeah, that's awesome. Well, it's great to have you back. And
it's great to be back.
We're going to have an awesome show today. And in typical Modcast fashion, there has been zero prep to this one. Zero. Literally, we had a whole show that we thought we were going to do. We worked on it for 10 minutes, and then we said, that's a little narrow.
We've been preparing for it our entire professional careers, with all of the knowledge that we've absorbed.
Yeah. So we bantered back and forth right before we said, let's go. And we said, that sounds good. Let's go with that one.
Yeah.
So here we go.
Let's do it.
This is going to be the components of a deal, right? So if I think about you're selling your business, and consideration is going to come into your life, and how does that come to you? When does it come to you? What are the components of it, right? Is it cash? Is it equity? Is there some deferred cash? Is there an earnout or a growth component that you get to go and hopefully take advantage of? And so that's what we're going to talk about.
Fun stuff, and I think really relevant for people who haven't been through a transaction yet and maybe thinking about it and want to know what to expect.
Yeah, there's some great questions that I think we get asked all the time in a deal, right? How often is my equity going to be valued, and what's it worth, and when do I get liquidity, and lots of stuff that we can kind of get into at the end as well. But all right, so somebody transacts with a buyer, and this is either you have a banker or you're kind of going out into this experience solo and finding somebody like us to transact with. You've agreed to a deal. Right. So you have a price, what you're going to get paid. And now you want to know, okay, well, how do I get that money? How does it come to me? And there's typically, I'm just going to speak generically.
Right.
There's typically deal consideration comes in this kind of way. There's some cash at closing, and we can talk about what closing looks like and what the mechanisms are that a lot of buyers use to get to a closing and sellers have to get to. So there's a closing, and that's when you receive some initial cash or closing cash. At that same moment, if you're taking equity in a transaction in the new firm that you're joining, that's when that equity oftentimes is allocated as well. And then there's a deferred payment. You've got to go do some things as a seller to maximize your purchase price, your quote unquote deal. And then oftentimes there's this fourth component, which is an earnout or an organic growth bonus, or, it's called a bunch of different things. But those are the 4 elements, right? I mean, would you add
Yep.
anything to that?
No, I think that's right. And I think it's worth sort of unpacking each one.
Yeah, we're going to dig deep, right? All right. So, Gary, I'm going to sell you my RIA, and we've agreed that you're going to pay me, let's just make up a deal. You're going to pay me $30 million for my deal. Okay.
No way.
Yeah, I'm really good and I'm worth it. All right. So you're going to pay me $30 million. We're going to transact. I've agreed to sell you the business for $30 million.
Yeah.
What happens next? Like how do I get the money? How do I get to 30 million?
Well, so I'll speak kind of from, obviously we have the way we do it because we do this.
Yeah. We'll describe it our way. Yeah.
And, we know there's other people who have, their own structures, but I think it's pretty common throughout the industry that you have the components that you described, which is it's not 100% upfront. It's usually not 100% cash. But so we're going to agree on a structure, and typically as a buyer, we're going to have our preferences as to structure, and it's going to be, a meaningful percentage of cash at closing. And I think, I know a year ago, Fidelity in their wealth management benchmarking of all transactions. So the average across all transactions that they surveyed across the industry was about 55% cash at closing. So somewhere between 50 and 60% cash at closing. Some people might be lower, some people might be higher. Some people might listen to this and say, no, that's wrong. But I'm just telling you that was a study that they did over like 140 deals or something like that.
Yep.
So, don't expect 90%. But what is closing? So closing, there's going to be a big document, a purchase agreement, whether it's called an asset purchase agreement or a contribution agreement or whatever the structure is.
Yep.
But, and it's going to define closing, but the sort of the key thing is the transition of the client assets to the buyer. And what that really is the consent process, which is going to either be negative consent or positive consent. Negative consent is when clients are notified that you're selling, and I'm talking about for RIAs right now, because there's a regulatory framework around this.
Well, and one other little note on that. You're talking RIAs. You're talking an RIA that has a client agreement in place,
right,
that allows for negative consent or requires positive.
Right. So yes, and thank you. I was going to get to that in a second. You're going to have an existing client agreement, whatever it is, an investment management agreement or a services agreement, and that agreement is usually going to state whether or not and how the agreement can be assigned. And I will say, in the hundreds of transactions I've been involved in over the years, it's a pretty substantial percentage of the time that the firm that's selling doesn't really know what their agreement says on that front until they go and look. So you may think it says one thing, but you may want to check before you start the process, because you've had many times people go, oh, it's negative consent. And then it's like, no, it actually requires positive consent.
Or you might have a current negative consent agreement,
right,
but that doesn't mean all of your clients are on that agreement.
Right. Or and sometimes there's a mix. You've changed it over time. You got a new consultant in who said, let's change this agreement.
Yeah.
And we've had those too, where it's like some people were in a negative, some were in a positive. So real quick, negative consent means you can notify the clients that you're going to be selling the business and assigning their accounts to this successor who's buying. It only requires that you notify them and that they are allowed a certain period of time to opt in, opt out, or be silent. And if they're silent, then they've opted in. That's why it's called negative consent. It's like a passive consent. And usually, And, there's a little bit of not an exact figure published on this, to my understanding, by the SEC, but usually, I mean, the council we've worked with, they're most comfortable with something like 45 days as a period to pass once you notify the clients. And then after 45 days, everyone who's either told you yes or told you nothing, their accounts move, get assigned to, your acquiring firm's master account at the custodian, et cetera, and they're under the new RIA. And that is considered closing. If it's positive consent, then they need to sign new paperwork, the paperwork of your acquirer, and which is more work, and a lot of people are scared of it. But I will say, and we can get to this, and we talk about like, how do you frame it? And maybe that's even another episode. But generally, the communications to your existing clients, unless there's something kind of wrong in your underlying client relationships, typically the consents are 99% or above. And sometimes they're more than 100% because people go, oh, hey, I've been thinking about moving this other account to you. This feels like a good time to do it. So we see a lot of advisors get very scared about this, but if you have good relationships with your clients and they're happy, as long as you have a good reason for making this transition, and explain it to them, then clients are generally gonna be very happy to go along with it.
And with DocuSign today, the process is a lot easier to go through.
It used to be reams of paperwork on a conference room table over a weekend, or getting them out into a bazillion UPS packages, and
it's a much faster process now. Okay, so just to kind of pick up the pace a little bit, so you get through consent.
You get through consent and you get to closing. Usually a buyer's going to have a percentage threshold of, we need to have a certain percentage of clients' consent before we're going to close.
And it's typically revenue. It's not number of clients. It's usually the revenue.
The revenue associated with those clients. Let's just assume you get to closing, whatever that period is, 30 days, 45 days, paperwork's done, negative consent's done. That gets certified. Boom, you have a legal close. You've sold your business. You're now part of this new company. That structure is going to differ, and that's a whole other conversation. It might be 100% buyer like us. You might have some mixed consideration, like some other firms do minority interests, and I think that's a whole other episode that would be interesting.
Or three.
But you're going to get the closing consideration, which is going to be that closing cash, and usually, certainly in our case, we want the sellers to have equity in our firm because we want them to maintain an ownership position and feel like owners and be owners. So some percentage of that purchase price is also going to come in equity, which will be granted at close. And there'll be a piece, it's a minority of the total purchase price. There'll be a piece that's deferred and will be earned and paid usually in a year, but there might be options for 12, 18, 24 months. And so piece one, closing cash, closing equity, that gets issued. You've hit your benchmarks, you get what's in the agreement, and you have that.
And that's when I get my 30 million.
And that's when you get 17 and a half of your 30 million in cash. And you get
I sold you a $30 million company.
And you get something in equity. Let's say there's another 7 or 5 in equity, and then there's 7 or so on the back end.
Yeah.
And then there's another piece that you can get in addition. We'll get to that in a minute.
All right. So first, let's just recap, right? I get to 95% of my revenue, or 90%, or whatever the buyer and I agree to. Of revenue signed over, either negative or positive. And now I'm ready. And I say, all right, fire up the jets, Gary. I'm ready. Here's my bank account number. You're going to wire me some dough, right? And that, per Fidelity, tends to be somewhere in the 55% range. And then you're going to allocate something to me for equity because I want to be an owner of this awesome portfolio of RIAs that you're building. Basically, I'm getting a mutual fund of RIAs. When I join a firm like Modern, I get the equity and a leadership team that's going to hopefully make that equity worth a lot more money. And then I'm going to work over some period of time, 12, 18, 24 months to get my deferred cash payment, right? That's kind of the three mechanisms: get the revenue, consents, my closing cash, my closing equity, and then some form of a deferred payment.
That's 3 of what might be 4.
Right.
So
Now we're going to go
so
into bonus land.
right. So
Yeah.
let's talk about how the deferred cash, just to make it clear, usually the deferred cash or maybe deferred equity. I'd say most firms will, while they're paying you upfront for the assets that have and the revenue that has consented, remember, they haven't received 1 penny of revenue
Right.
at that point. You know,
Nada.
it's a pretty good deal for you as a seller that you get paid a significant chunk of a price,
Man, I hope they
and the
come to
buyer
work on
has
Monday.
literally gotten nothing.
Yeah, I hope they come to work on Monday.
You hope the people come to work on Monday and that the clients don't turn around and say, you know what? Yeah, no, we're good. We were going to go somewhere else. So anyway, that usually doesn't happen. But so there's a deferred piece that will get paid at the end of a year. It might be based on revenue. It might be based on EBITDA. That's like, okay, here was the number we agreed to that was where the business was. And we're going to pay you this deferred piece at the end of, let's say, 12 months based on us actually having gotten what we thought we were going to get.
Yeah, like you deliver as the seller, me in this scenario, right. I deliver the business over the next 12 to 18, 24 months.
It's basically just retention of what was there. That's usually pretty easy.
Yep.
You know, and you get to there and then.
Now I have my 30 million.
Now you have your 30 million.
Yeah. Okay. Got it. All right. All right. So those are the pieces of a typical transaction. It's what we are seeing currently in the marketplace. The percentages are going to change. The equity piece is going to move around. How you get it is going to be a little different. I want to talk about something that we talk about every single time we're looking to bring somebody into the firm. And this is a very valid conversation to have. And that is, what is the equity? What am I getting? And I think it's important as a seller, somebody who's joining an organization, you better understand the equity. And because not all equity is created equally, not all equity behaves the same. And some firms, some buyers have instruments that operate wildly different than the equity that you might have. So let's talk about that, right? We've seen deals recently, competitor scenarios, where we're being told, we haven't seen the actual documents, but we're being told by potential partners or future partners that, oh yeah, they were going to give me equity, and that equity had a preference, it had a hurdle, it had a performance rate that was required. And private equity had one share class, management and leadership had a different share class. And then me, the seller, I was going to get yet a third share class. Let's talk about that.
Yeah. And there can be really, really complicated equity structures, or what people call waterfalls in this business,
or several waterfalls.
Who gets what, how proceeds are distributed in a sale.
Yeah.
So when you're taking equity, and I think it's really hard for individual sellers, even though we're talking about people who are financial advisors, you know, it's a very different thing to sort of, you know, even if you're an investment centric advisor, very different thing to be sort of advising on public companies with public company research and, you know, a public stock than, you know, private companies. And so there can be many, many classes of stock, or there could be few or one class of stock. And, you know, it's not uncommon for there to be, and there's not necessarily anything evil or bad about this. It's just something to know that, you know, money investors who have put the money in that then that went into your account, you know, they have certain terms, and those terms may vary depending upon when they invested, how they invested, you know,
they have rights,
what the management team or you know, was sort of their focus was at the time. And so there, you know, you could be sitting behind different classes of stock where you might have a common stock, but there's preferred stocks, preferred equity instruments that have to get paid out a certain percentage, what you just refer to as a preferred return is a typical structure where an investor might be guaranteed a certain percentage return before the money starts flowing through the waterfall. And the waterfall is a waterfall, like literally it's okay. There's a price paid if you actually had a sale,
Yep.
which by the way, there are very few in this business, but let's say if you actually, but we were part of one.
Yeah.
If you actually had a sale, it's like, well, who's at the top of the stack and who's at the bottom of the stack? Or is it one layer? We happen to have, our company has today a very simple structure, which we won't go into publicly, but people who talk about joining us, get all that information. But, there can be very complicated structures. And so you want to ask, and educate it. If you can, if the equity is just kind of a lottery ticket to you and you're not really worried about it, okay, that's cool. But if you want a sense of what the value of the equity is, you want to say where does this sit in the stack? Where does this sit in the waterfall?
Where am I in the line?
Where am I in the line?
Yeah.
When people are getting paid out, how long of a line am I in?
Right.
Or is everyone getting the same thing at the same time?
Yeah.
That's one question. That's a much easier question to answer, and every buyer ought to be able to tell you the answer to that. The second, though, which is much harder to answer, and all of you know this because you can't tell me what any stock is going to do tomorrow in the public marketplace, right? Is how should I think about this equity? Like, is it going to, how will this appreciate, or will it appreciate? Will it depreciate? Like, what is this company doing? What are their prospects? How is it different than me on my own? Now you do need to be honest with yourself about what your growth rate is, which goes back to episodes 1 and 2 and 3. But, so like, that's a whole other thing that you really will not have an answer to, but you could have a feeling about. And, if you generally believe in the industry and the business you're in, you're probably going to generally believe, well, it's going to go up. And if I'm joining a firm that's more diversified, a mutual fund or an ETF of RIAs instead of just my single equity, then, my risk is diversified, growth rates diversified, and it might do better. And these people are pouring money into it. So, you'd think it would do better. But the first one on where do I sit in the equity waterfall?
Super important.
Is a super important question. And I don't know if we hear a ton of people asking it proactively.
Well, I'm gonna give you something. So I had dinner this week with a group of industry leaders, and I just happened to be invited, and it was a fantastic meal, and we had a great discussion. And one of them had just read a minority investors document. So they had just read a document where this minority investor, and we should do a whole episode, as you mentioned earlier on this, they were buying 24.9% of the business. So it didn't have to be repapered with all the clients.
Yeah.
If you're less than 25%, you oftentimes don't have to repaper the
change
clients.
of control from a regulatory standpoint. Yeah.
Although they were investing at a valuation at 24.9% of the business, they were taking 40% of the outcome.
Sure.
So they bought 24.9% of the business, but the outcome they were going to receive is 40%. So why did that 15.1% additional, I'm in front of you in line, I get a better return than you mechanism make sense?
Why does it make sense?
Oh, no. That's a question I definitely would be asking.
Is that a rhetorical question?
Yeah,
yes,
it's rhetorical.
You should be asking that question.
Yeah, and that's something we should talk about. And that's just a whole nother version of a pref.
And you could decide it does. I mean, people go, what's the classic hedge fund structure, 2 and 20, right? I don't know if people still charge that, but like
There are people out
2%
there that do. Yep.
and 20% of the profits. And it's like, well, I pay that because I want them to be incentivized to make a ton of money, and 80% of a big number is better than 100% of a small number.
Or no number.
Assuming the big number is more than 20% higher than the small number.
Yeah.
But anyway.
But these are all things that you need to be aware of when
Right.
you're either selling a business to someone to become part of their organization,
Yeah.
or selling a minority sleeve, and be aware of what you're giving up.
And I would just say,
and again, we could
another,
do a whole nother episode on that.
I would say another tip for sellers, because I mean, look, an educated seller is, there was this, did you have Sims men's clothing in your area? Or was that a local, was that a
Sims?
local brand? It was
No, I
like
don't.
it was like a discount suit clothier, like in the 80s. Might have just been a Washington DC area thing. But anyway,
Sims
they
or
had this,
Sims?
no, it was called SYMS. Anyway,
No,
they
I
had this
didn't know that.
their tagline on their TV ads was, "An educated consumer is our best customer." Because their thing was, we provide value.
Yeah,
So,
yeah.
an educated seller is our best joiner, like,
Right.
it's good if you know what you're looking at, because we think we're offering something really good. But if you're hiring a banker, you should ask your bank. If you're interviewing bankers, you should ask your banker, will you help me understand this? Or if not, a good lawyer, a good securities lawyer, can help you unpack what are the rights of the other people, and are they reasonable? Are they in market? Because anyone could scare you and say, "Oh my God, so and so's got rights that you don't have." Well, they're good reasons why.
Yeah,
There
it's
could be
not
different,
necessarily bad or wrong
not
that
necessarily
somebody has
bad.
rights. Yeah.
No, and the thing you should always understand is, if someone invests money, just like if you invest money in something private, you're going to, look, if you're a passive individual angel investor or something like that, it might be very simple. But sophisticated investors, regardless of the percentage ownership, regardless if it's control or not control, they're going to get the rights that they care about. And so just understand what those rights are.
Yep. And again, it's not that it's wrong or bad. It's just how many people have, more rights than you before you get paid.
Yeah.
Right.
And what are those rights?
Yeah. What are those rights, and how much is coming out of the pool of money before it gets divided at your share class level?
Yeah.
That's it.
And that's it.
That's it.
So,
I would say, look, hey, we should probably, as I like to say, land the plane here pretty soon.
let's land the plane.
Yeah, let's land the plane. But I think there's
Stow your tray tables.
yeah, put your tray tables in the upright position and stow those laptops, people.
Yeah.
By
the way, an iPad is not a laptop, so they really need to make me,
because it has a
keep my iPad on.
detachable keyboard.
What if I take the keyboard off?
No, that's what makes it not.
Oh, okay.
It makes it takeoff and landing safe because it doesn't have a keyboard.
Great.
I don't understand.
Sometimes they think it's a laptop.
Yeah, and you just take the keyboard off, and look, we spend far too much time on airplanes. Okay, so anyway, I think there's an important group that we haven't even touched on, and we should in a future episode talk about your team.
Yeah, I think it's worthy of another episode, which is thinking about your team.
Yeah.
As part of the sale, and how do you appropriately incent and reward your team who might not be owners
today
as you approach the sale, but are going to be critical to delivering and maintaining and growing the business.
Yep. And guess what? They were there to help you build, to help you maintain, to help you grow before the transaction. And again, we'll get into a whole episode on this. I think that would be a good one for us to remember to kind of just get in and dig in on.
Let's just come back. If we just watch the end of this, we'll remember that we said that.
Well, I think Alex and Paul might remind us, but anyway. All right. Anything else on deal structure? I mean, this again, off the cuff, just hopped on and
no, those are the big elements. And I think as people are approaching, it's just good. I think again, this is just for people out there who are thinking about
Yep.
talking to someone or monetizing their business, like this is what you can expect in terms of the components, and you start from there and then you get into some of the details.
Yeah, just a quick recap. So there's closing cash, there's usually equity allocated at closing, there's some deferred cash for delivering the business, and then there's usually an earnout or a growth component that you'll get the opportunity to take advantage of as well. And understand the equity. That if you're taking equity, understand what you're getting. And as you mentioned earlier, all of our partners have equity. It's really important for us that remain true, and that we're all building something amazing together. I'm Gordo, that's Gary. This is episode 15. Have a great day.
Thanks, everyone.